global corporate tax is a huge development. American Treasury Secretary Janet Yellen proposal on corporate tax, and again US President plan correlated with Yemen's comments are important. What could be the impact of the multinational companies? What are the trends on profit shifting, taxation and earnings? What are the implications on different countries? We have to look at it. The American Treasury Secretary Yellen earlier last week announced that Washington would push for G20 for an agreement on global minimum corporate tax to stem the erosion of government revenues, and the bloc is expected to unveil a proposal by July. This is for corporate, not for individuals, but they want to have global consensus. We can use global minimum tax to make sure that the global economy thrives based on a mere corporate tax system, more level playing field in the taxation of multinational corporations, and spur innovation, growth and prosperity. Tax havens should be discouraged. That's our focus as such. So it will also give a level playing field, and it will create more innovation, more growth and more prosperity. Collectively they want to bring it up. Now, American President also commented on Yellen's comments. President Joe Biden's infrastructure proposal called the American Jobs Plan would increase the minimum tax on US corporations to 21% and calculated on a country-by-country basis to deter companies from sheltering profits in international tax havens. The plan would also raise the corporate income tax to 28% from 21%. The rate has been as high as 35% before former President Donald Trump and congressional Republican cut taxes in 2017. One reason the Trump administration cut the corporate tax was the rash of US companies offshoring or moving their domicile to countries with lower corporate tax rates, even though much of their operations happen domestically. US multinationals face another blow. The prospects of a domestic corporate tax rise to 28% from the 21% levy set by the former President Donald Trump in 2017. That plan to face still opposition within the Congress. Market appeared skeptical a 21% rate would be adopted and it would take a long time to negotiate. Now, as far as the multinational companies are concerned, a global minimum corporate tax could deal a major blow to the multinational, with some government alleged that shift billions of dollars in profit every year to low tax havens, as well as triggering a fundamental reassessment of the corporate earnings. High-profile names including Apple, Google, Starbucks have been accused by the governments in Europe using legal loopholes in fragmented global taxation regimes to play, and they are paying less tax as well. So they're using the loopholes. So tax advisory, tax planning becomes tax evasion in substance. Minimum corporate tax levels would stamp out the ability of the companies to move income from intangible sources such as patents, software and royalties to countries with lower taxes, lower interest rate again. So it remains to be seen what sort of consensus coming across the various countries. Profit sharing, taxation earnings, profit sharing amounted to almost 40% of the multinational profits. That 35% of the profits came from non-haven EU nations, while 25% from the United States. Although technology and healthcare firms are seen as major beneficiaries of tax arbitrage, stock market investors appear not to be faced by the threat to the company's earnings. Their focus is possibly on an expected rebound in the corporate earnings, with US companies set to report a 25% profit jump and a near 14% rise in 2022 and the damage inflicted by COVID-19 pandemic. What are the implications of different countries? Irish Finance Minister Pascal Donohoe voiced reservations about the proposal, while the World Bank has warned against settling a minimum tax rate that's too high, saying it would hinder the poor countries in attracting investments. The proposed reforms would probably also lower public revenues. Poorer European states, Hungary and Bulgaria, and with statutory taxes of 9% and 10% respectively. So, depending upon your fiscal requirement and the competitive offerings, ease of doing business, tax varies in different countries, and it would shift taxable revenues back to high tax countries such as France, Germany, Italy, where the rates ranges from 28 to 32%. So plenty of challenges in bringing uniformity, and emerging markets, developed markets, within the developing market there are contentious issues to bring minimum. Within the developed market also you have contentious issues on account of business competitive offerings. So it remains to be seen how far there is a consensus between G7 and G20.